Hi, Dr. Phil here. So this is a video on net present value and other investment criteria. So let's talk a little bit about some of the things we'll discuss in this chapter. So the capital budgeting question is probably the most important issue in corporate finance. This is the process of allocating or budgeting capital, which is usually more involved than deciding whether to buy a particular fixed asset, right? So for example, should we launch a new product or should we enter a new market? The most fundamental decision a business must make concerns its product line. For example, what services will we offer? What will we sell? In what markets will we compete? And what new products will we introduce? So the first main thing I want to talk about in this video is what we call NPV, net present value. Okay, so an investment is worth undertaking if it creates value for its owners. All right, but the idea is how do we know if it does or not? Capital budgeting is all about trying to figure out whether a proposed investment or project will be worth more once it's in place than its costs. And it involves this whole idea of discounting future cash flows back to present value. Think about the term net present value. So NPV is the difference between an investment's market value and its cost. That is a measure of how much value is created or added today, again, discounting all those future cash flows back by undertaking an investment. Capital budgeting process can be viewed as a search for investments with positive net present values. Investment decisions are generally simplified when there's a market for assets similar to the investment we're considering, so we can see, what the value is, what the new value is, what the used value is, and so forth. Capital budgeting becomes more difficult when we cannot observe the market price for at least roughly comparable investments, and of course that does often happen. All right, so let's take a look at estimating the net present value. So suppose we believe cash revenues from our fertilizer business will be $20,000 per year. The cash costs, including taxes, will be $14,000 a year. We will wind down the business in 8 years' time. The PP&E will be worth $2,000 as salvage at that time. The project costs $30,000 to launch. So think about that $30,000 as in like today. And we use a 15% discount rate on new projects such as this one. So the question is this a good investment? If there are 1,000 shares of stock outstanding, what will be the effect on the price per share of taking this investment? So the present value, as always, we're just going to use a formula. We're going to plug in our numbers. We got the 6,000, which is the difference between the 20,000 and the 14, times 1 minus 1 over, again, we're doing the reciprocal, 1.15, which is the interest rate or the discount rate, to the power of 8, because they said 8 years. If we simplify all that out, what do we get? We get 27,578. Now we know that the amount we have to invest today is 30,000, but that's today, right? So that's already in today's dollars, so we don't have to discount that. So 30,000 plus the 27,578, and then what do we get? Negative 2422. So let me I forgot to mention this. This is a negative number, negative 30,000 because we're spending 30,000 today, and we're getting positive 20. The present value of all the future cash flows is positive 27,578. So you notice that the NPV is negative 2422. Thus, this is not a good investment. So we would not undertake this. It doesn't actually mean we're losing money. It just means we're not hitting the discount rate. So the estimated impact of taking this project is a loss of 2422 divided by the 1,000 shares is $2.42 per share. So an investment should be accepted if the NPV is positive and rejected if it's negative. Okay, so here they're just kind of showing you what we just did here, right? This is the example we just did on the last slide. You can see the inflows, 20 coming in. You can see the outflows, all these negative 14s. And then we have the net flows here, so this is what all the sixes represent, right? And then of course there's an extra 2 at the end, as we just discussed. So sometimes setting these things up as a timeline can be a little more helpful as far as your brain going, okay, yeah, that year we have this coming in, that going out. Next year this comes in, this goes out. So using what we call the NPV rule. So suppose we're asked to decide whether a new consumer product should be launched. Based on projected sales and costs, we expect that the cash flows over the 5-year life of the project will be 2,000 in the first 2 years, 4,000 in the next 2, and 5,000 in the last year. It'll cost about 10 grand to begin production. We're going to use a 10% discount rate to evaluate new products. So what should we do here? So given the cash flows and discount rate, we can calculate the total value of the product by just simply discounting the cash flows back to the present. So the present value of the 2,000 over 1.1 plus 2,000 over 1.1 to the power of 2, because the second year, and then in the third year, 4,000. You can see the 4,000 for the next 2 years to the power of 3 and 4, and then 5,000 over 1.1. And again, 1.1 is a discount rate 'cause it's 10%, so you do 1.1 to the power of 5. And then if we simplify that out, we get 12,313. So that represents the present value of the expected cash flows. But the cost of getting those cash flows is only 10,000, right? So the NPV is just 12,313 minus the 10, and we get 2313 positive. So because it's positive, it means that we're at least achieving our hurdle rate of 10%. So we should proceed. All right, the payback rule. This one is really simple. So the payback period is the amount of time required for an investment to generate cash flows sufficient to recover its initial cost. Based on the payback rule, an investment is acceptable if its calculated payback period is less than some specified number of years. So you can see below, the initial investment is 50 grand. You can see the minus 50 down here. After the first year, the firm has recovered 30 grand, leaving they've got now 20,000 to recover. Cash flow in the second year is exactly 20, so we would say the payback period for this investment is exactly 2 years. So you spent 50,000 now, you recovered 30,000 in year 1, and then by the end of year 2, you've recovered your investment. Anything moving forward you're now putting you in the positive. So as you can see below, table 9.1 kind of illustrates cash flows for 5 different projects, A, B, C, D, and E. You can see what they spent up front. Like for A, they spent 100, they got 30 back in year 1, so they're out 70. Year 2, they got 40, so now they're out 30. And then in year 3, they got 50, so now they're over. And I went ahead and put if you want to pause it here and take a look at those, you can. I'm not going to go over all of these, but you can kind of get the idea. We're spending money up front. How long does it take to recoup the investment? Now, when you think about the payback rule and you compare it to the NPV rule, it definitely has some severe shortcomings. That's why, frankly, it's not really used a lot in industry, in business. One is because, as it says, time value of money is completely ignored. So we're not discounting things back based on discount rates, which honestly is a huge disadvantage because it's not really realistic to not do that. The payback rule fails to consider any differences in risk, which we can factor into the discount rate or the NPV method by we can adjust the discount rate to compensate for that. There's no economic rationale for looking at payback in the first place, so we don't really have any guide for how to pick the cutoff. Then suppose we have somehow decided on an appropriate payback period of 2 years or less. So if we look at these investments, right, long and short, so we both spend negative 250. And then if you look at short, short is going to get us to the payback period, right? So we would look, oh, okay, well, we should invest in short, right? Because we're looking for 2 years or less. But then what happens in year 3 and 4? Nothing, right? Whereas long, yeah, it takes a little longer to get there, no pun intended, but we end up making more money overall. But based on this rule, we would reject long and we would select short. So you can kind of see how this is detrimental. So, yeah, so this is just talking about the payback for the 2 we just looked at. And the point being that, let me just go back real quick. We should actually take long because we'll make more money by the end of year 4. But if we just strictly go with the rule, then we're going to accept short. We're going to make 300 bucks where we could have made 400. All right, so what are some redeeming qualities of the rule? So the payback period rule is often used by large and sophisticated companies but only when they're making kind of small decisions, right? Many companies, they don't want to spend a lot of time and money on detailed analysis because the cost of having all the accountants and finance people who run all this analysis, it just isn't worth it, right? So this is biased towards short-term projects, so thus it's biased towards liquidity, right? Think about liquidity as the ability to operate in the short run, like the current cash you have on hand, accounts receivable, inventory, supplies, prepaid, stuff like that. Cash flows that are expected to occur later in the project's life, you could argue are more uncertain, and the payback period rule, in a kind of a crude sense, adjusts for the extra riskiness of later cash by just ignoring them altogether. It's sort of like worst case scenario for like long term. It's like saying, we're just going to assume that we're not going to get these. So, summary of the payback rule. So the payback period is a kind of break-even measure in a sense. The biggest drawback to the payback period rule is that it doesn't ask the right question. The relevant issue, as we talked about, is the impact on investment that we'll have on the value of the stock, not how long it takes to recover the initial investment. So it's like they're asking the wrong question, in that sense, in that context. Because it's so simple, companies often use it as a screen for investment decisions. And then we got some pros and cons of the payback rule listed down here. So like advantages, it's obviously very easy to understand. It adjusts for uncertainty of later cash flows. It basically just says, we're just going to assume you don't get them. It's biased towards liquidity. Again, think about money in the here and now. Disadvantages, probably the biggest one. Number one, it ignores the time value of money, just using, discount rates to drag those future amounts back to current value. It requires an arbitrary cutoff point, 2 years, 5 years, whatever it may be. Um, it ignores cash flows beyond the cutoff date, and it's biased against long-term projects such as R&D and new projects. So now let's take a look at what we call the discounted payback. So we can think of the discounted payback as the length of time required for an investment's discounted cash flows to equal its initial cost. So based on the discounted payback rule, an investment is acceptable if its discounted payback is less than some pre-specified number of years. So suppose we require a 12.5% return on new investments. We have an investment that costs $300 and has cash flows of $100 a year for 5 years. To get the discounted payback, we have to discount each cash flow at 12.5% and then just start adding them. So that's kind of what they're doing down here, right? So we've got the undiscounted cash flows 100, 100, 100. And then we've got the, based on 12.5%, you've got the discounted amounts here. Obviously, like this would be technically 88.5, but it's rounded up to 89. That's fine. And then what they're doing over here is, you can see here, like accumulated cash flow undiscounted. So the 1, the 2, the 3, the 4, the 5. And then we have the accumulated discounted cash flow. So it's like saying, yeah, we technically get 500, but it's not really worth 500 because you're not discounting it. If you discount it at a 12.5% rate, then it's really only worth 356. So this is like taking the payback period and actually adding in some discounting to kind of solve that first problem we talked about. Okay, so discounted payback is the time it takes to break even in an economic or financial sense. In other words, we get our money back along with the interest we could have earned elsewhere in 4 years. So like I say, it's now taking into account the discounting. If a project ever pays back on a discounted basis, then it must have obviously a positive NPV, right? Because if you get a negative NPV, it doesn't actually mean you're technically losing money necessarily. It just means that you're not definitely hitting your interest rate, your required rate of return. So if we use discounted payback rule, we won't accidentally take any projects with negative estimated NPV. Now, this is rarely used in practice because it's not any, like it says, it's not any simpler than NPV. So why wouldn't you just use NPV? Okay. If you look at the graph over here, they're just kind of showing you, okay, yeah, this is, you can see the future value of the initial investment, the future value of the projected cash flow. So we kind of got to be at this point, right, before we can consider it a good. If it's down here, like bottom left, it's not a good investment. If it falls in the top right, kind of quadrant up there, if you will, then it represents a, maybe a viable investment. Okay, so the next one is to talk about is the average accounting return, AAR. So this is an average net income divided by its average book value. It's pretty straightforward. So let's just look at an example. So let's say we're going to open a store in the mall. The required investment in improvements is 500 grand. The store would have a 5-year life because everything reverts to the mall owners after that time. The required investment would be 100% depreciated straight line over the 5 years. So with the depreciation would just be the 500,000 over 5, as I put there. So we have 100,000 per year depreciation. The tax rate is 25%. So we're going to look at table 4 on the next slide. It's going to show us our revenues and expenses, and then we'll also show our net income in each year. So here you can see our revenue, and you can see it changes through the years. We've got our expenses, we've got our earnings, which of course is just revenue minus expenses. We've got the depreciation, remember 500,000 divided by 5, and then we have our earnings, and then we have what we're taking out for taxes. So the average net income, all we have to do here is we're just going to add, look at your net income, the 100 year 1, 150 year 2, 50 year 3, nothing in year 4, and then negative 50 in year 5. And then we're just going to divide it by the 5, and we get 50,000. So I think it was basically 100, that's 250, right? And then the 50 and the 50 cancel out, so it's just 250 over 5, and we get the 50,000. So the average book value is the 50,000 plus 0, and then just divide that by 2. and then we get an answer of 250,000. Again, it's okay, but it's not taking into account any discounting. So we started, as it says, we started out with a book value of 500. The initial cost of the equipment, we ended up with 0. So the average book value is, of course, 250,000. So we got the average net income as we did our little calculation. If I go back right here, 50,000. So the average accounting return is the average net income of 50 divided by the average book value of 250 is 0.2, or we can just say 20%. So if the firm has a target AAR of less than 20%, then this investment is acceptable. If their target AAR is say like 25%, then this is too low, then it would not be acceptable. So use of this rule has a number of problems, which again, honestly, this isn't used very much in the real world. The chief drawback is that AAR is not a rate of return in any meaningful economic sense, but rather the ratio of just simply two accounting metrics, two accounting numbers. And therefore, it's not comparable to the returns offered in financial markets. So one reason AAR is not a true rate of return is that it ignores time value. Okay, so it lacks an objective cutoff period. So target AAR may be specified by calculating AAR for the firm as a whole and then using this as a benchmark. It doesn't look at cash flow or market value, but instead it focuses on net income and book value, which frankly are, as it says, they're really poor substitutes. So advantages and disadvantages, obviously it's easy to calculate. It's easy to get the information because you can usually just pull those right out of the financial statements. Disadvantages, it's not really a true rate of return, as I said, because again, like some of these other methods, you're ignoring the time value of money. So it's not really realistic. It uses an arbitrary benchmark cutoff rate, and it's based on the accounting book values, not the cash flows and the real market values. Like what could you replace those assets for? Okay, internal rate of return, IRR. So think of the IRR, it's the discount rate that makes the net present value of an investment zero. So to determine the single rate of return summarizing the merits of a project. Okay, we want this rate to be an internal rate, i.e. it depends only on the cash flows of a particular investment, not on rates offered elsewhere, hence the name internal. So consider a project that costs $100 today and pays 110 in 1 year. Suppose you were asked, what is the return on this investment? So obviously the answer is 10% because for every dollar in, we get a dollar and 10 cents back. Is this project with its 10% IRR a good investment? So based on the IRR rule, an investment is acceptable if the IRR exceeds the required return. If it's not, then it should be rejected. So if we have a required return of say 8%, if the IRR is 7, no. If the IRR is 8, if it matches, then yes. And if it's over 8, then yes, we would. So at a discount rate of R, the NPV is just subtract the 100 that we're investing, add the 110 we're getting back over 1 plus R. So, but what if we don't know the discount rate? So we can still ask how high the discount rate would have to be before this project would be deemed unacceptable. So remember, the investment is at least economically a break-even proposition when the NPV is 0 because value is neither created nor destroyed. We're just hitting that target rate. Nothing more, nothing less. So to find the break-even discount rate, we set NPV equal to 0 and we solve for R. So you can see down here, we got the NPV equals 0, minus the 100 that we're spending, plus the 110 we're getting back over 1 plus R. And then if you just solve for that, solve for R, then you're going to get 0.10. So the IRR on an investment is the required return that results in a 0 NPV when it is used as the discount rate. So let's look at a multi-period example of IRR. So let's say you're looking at an investment that costs $100 and has a cash flow of $60 per year for 2 years. So what is the return on this investment? So we got $100 going out now. We got 60 at the end of year 1, 60 at the end of year 2. So we'll set the NPV equal to 0 and we'll just solve for the discount rate. So the NPV equals 0, subtract the 100 that's going out now, add the 60 over 1 plus the IRR, and then add 60, 1 plus IRR to the power of 2, because that's the second year. So only way to really find this is, if we're doing it this way, is to just trial and error it by hand, or you could actually use a financial calculator that'll just hit a few buttons and it'll tell you. So in this case, the cash flows form a 2-period $60 annuity. To find the unknown rate, we can try different rates until we get the answer. So at a 0% rate, the NPV is 20. A 10% discount rate, we get $4.13. We keep going. You can see some of the other examples I did here. So the NPV appears to be zero with a discount rate between 10 and 15%. So what we're saying is the IRR is somewhere in that range. It turns out to be, if you do it in Excel or on a calculator, it's about 13.1%. So if our required return were less than 13.1%, then we would take this investment, right? Because the IRR would beat our hurdle rate. But if the required return exceeds 13.1, then we would say no, it's too low, we're going to reject that. Okay, last thing I want to talk about in this video, what we call the profitability index, the PI. So this is a kind of a cost-benefit ratio. So it's the present value of an investment's future cash flows divided by its initial cost. So this is very simple, by the way. So if a project costs 200 bucks and the present value is 220, then we just divide the 220 by the 200 and we get 1.1. So if a project has a positive NPV, then the present value of the future cash flows has to be bigger than the initial investment, right? So profitability index will be bigger than 1 for a positive NPV investment, and it'll be, of course, less than 1 for a negative NPV investment. So how do we interpret this profitability index? So if you think about like the profitability index of 1.1, it tells us that for every dollar you invest, you're basically getting $1.10 in value. Or, I mean, a dollar of it was already yours, so you're getting an extra 10 cents in that sense. So what are the advantages and disadvantages of the PI, the profitability index? So first one is it's closely related to NPV. So it's generally leading to the same decisions, like the same accept and reject decisions. Easy to understand and communicate, and it may be useful when available investment funds are limited. One of the disadvantages is may lead to incorrect decisions when you're comparing mutually. When we say mutually exclusive, just so you know, that just means if we accept project A, we can't accept project B, and vice versa. Okay, that's the end of the video. Thank you for watching, and see you all soon.